Chainlink secures more than $34 billion across 525 protocols. Last 365 days, it collected $58 million in fees for that. Meanwhile, the company that settles every stock trade in America just built on it. A major bank initiated coverage at $200, and price sits near $950. One of those numbers is lying to you. Stay with me, and you'll know which one and exactly where I'm accumulating. Here's what makes this hard. Almost everything I'm about to walk through is bullish, and the weekly chart on your screen shows a token grinding sideways for years, still far below where it traded in 2021. That gap between the news flow and the price is the whole story, and most people resolve it by picking a side and shouting. I'd rather show you the mechanism, because once you understand why adoption hasn't paid yet, you understand the exact moment it would. And that moment has a date on it. Start with the biggest. On May 12th, the DTCC announced its collateral AppChain will run on the Chainlink runtime environment. The DTCC is the plumbing under American equities. Collateral is what banks post to back trades, and today it crawls, only in business hours. The new platform runs it around the clock, live in the fourth quarter. Swift went the same way. 11,500 institutions move money through it, and in January it closed a tokenized bond trial with BNP Paribas, Intesa Sanpaolo, and Societe Generale. Project Pangea pulled 50 banks holding $10 trillion into rebuilding cross-border settlement, and JP Morgan and CME settled a live tokenized securities trade through the DTCC. Then the one nobody quotes. BitGo deprecated its own bridge and migrated $7.4 billion of wrapped Bitcoin onto Chainlink's cross-chain protocol exclusively. That's an incumbent killing its own product because the alternative won. The consumer layer followed. Robinhood adopted Chainlink for its chain and stock tokens. Tokenized U.S. equities went live on Hyperliquid through X stocks, a door into a $150 trillion market. Then OKX, Aave, Circle's new chain, Obligate, Radiant Prime, Nillion. There's also a newer buyer. Chainlink now sells to AI agents. For example, one holding $1,000 scans yields across chains, sees 3.3% on Ethereum, 3.4% on Base, 3.2% on Arbitrum, bridges to the best, and deposits. Coinbase's Standard moves the money. Chainlink verifies the truth. Standard Chartered saw all this and initiated coverage forecasting $200 by 2030. Read the small print. The same model puts Link at $13 by year-end. The moonshot is backloaded, resting on tokenized assets growing from $340 billion to $4 trillion by 2028. The posture is shifting. Chainlink retired its big public conference for an invite-only banking event in New York this October. Rory, director of Web3 at Chainlink Labs, believes this new format is the best way to accelerate the adoption of Chainlink technology where it matters most. Finally, less hype, more deals. Spot ETFs absorbed $129 million since December across 9 straight green months, and the average ETF dollar is roughly 6.5% underwater without ever net exiting. Sticky. But August's inflow so far is 1.2 million against 59 million in December last year. Direction intact, size gone. Holders just hit an all-time high near 904,000 wallets, and of the 1 billion cap, 748 million circulate. 252 million sit off market. Now the number that decides it. $58 million of protocol revenue lasts 365 days, and the weekly bars barely moved. Against a 7 billion market cap, that's a 120 times price to sales. Every headline I just gave you, and the fee line is flat. So the question is not whether Chainlink is winning, it's whether winning ever reaches the token. Hold that, because the chart asks the same thing. Zoom out to the weekly time frame, because on daily candles, this is noise. In September 2025, Link topped near $26, and a descending trend line formed off that high, the white dotted line on screen. Price broke above it in April, which looked like the turn, then got rejected at the 21-week exponential moving average and rode that line back down as resistance. By July, price was back at the February lows, sitting exactly on the 1618 Fibonacci extension at $7. Same level, second time. A double bottom, and it printed the week of my last Chainlink video. For anyone newer, I anchored that Fibonacci from the 1160 low in June to the $26 high in September. The 1618 fib is where sellers historically run out of size. Price bounced, and it's up more than 30% off the lows, with finally the first weekly close back above the 21 exponential moving average since October last year. One close is a signal. Two in a row is a trend. Prices above the 10 and 21 exponential moving averages, blue and red, under the 55 and 100, purple and yellow, and under the green 200-week simple moving average near 1250, reclaiming those turns a bounce into a cycle. Now the indicator underneath, that's a Heikin-Ashi Relative Strength Index, smooth momentum. In February, it hit the most oversold level in its history. Since then, price made a lower low into July, while the indicator made a higher low. Bullish divergence, selling pressure fading as price falls. The white circles mark every prior instance: 53%, 176%, 280%, 379%. Same reading now. Right here is the ceiling of the 2022 to 2023 bear range. Above it, 1160, the last rejection zone. Then 15 at the 0618 fib. Downside is simpler. A weekly close below 7, and 555, the red dashed line, becomes the magnet. That was support all through the last bear market. My load zone is $7 to $10, the green box, long-term view, and I'm accumulating slowly. Take profits are 1160, 15, 20, 26, and 34, scaled out in pieces rather than at once. I buy oversold and de-risk into overbought, and this is not the overbought part yet. Here's the yield angle. $86 million of Link sits in Aave earning 0.03%, which is collateral for borrowing, not yield seeking. $67 million sits in liquid staking at 4.5%, the honest passive rate. A Uniswap pool with $21 million pays 20%. You'll also see pools advertising 65% holding 100,000. That's thin liquidity. Used properly, a range is an accumulation tool. Set it under spot, and you buy weakness while earning fees. Above spot, you de-risk into strength. None of that proves the trend turned. So let's talk about what would. Best case is clean. The DTCC switches on in the fourth quarter. Cross-chain volume converts into fees, and that flat revenue line bends. That's my falsification test. If the largest settlement infrastructure on Earth goes live and weekly fees still sit near 1.1 million, the token isn't capturing the adoption, and no headline fixes that. Worst case repeats 2022, when Link ping-ponged between $5 and $9.50 for well over a year. We're at that upper edge right now. The difference is the revenue, the development, the institutional base. To be fair, in my view, we don't revisit 5. But the market doesn't care what I think. What changes my thesis? A weekly close below 7. Or Pyth, already on 316 protocols with a fraction of the value secured, winning new deployments while Chainlink defends old ones. Chainlink won the infrastructure war and is still waiting on the invoice. The chart just gave its first constructive weekly close in months, off a bottom that's held twice. The best entry passed, and I'm still accumulating at the edge of my risk-reward. If this made you think more clearly, a like and a subscribe helps the channel reach people who need it. If you want the execution rather than the thesis, that's the Pro Capital Vault. Real-time portfolio tracking, my exact zones, weekly live calls, Sunday prep report. Join button below, pinned comment, or the QR code on screen. Then sync YouTube to Discord and the channels unlock. One for the comments. If the DTCC goes live and revenue stays flat, does that change your thesis? Watch my last Chainlink video for how we mapped this bottom. None of this is financial advice, just my analysis and positioning.